Everyone predicted the housing market would collapse, but here we are, stronger than ever. So why did the crash never happen? In this video, we'll explore the surprise reasons behind the resilience of the housing market and what this means for the future. This is going to be a good one. And in case you don't know me, I'm William Gale, and I've spent since 2012 building a UK-wide home buying company and estate agency that has dealt with over 13,000 transactions, totaling about £3.3 billion of property. So understanding this stuff is sort of my bread and butter. So let's get into it. We've all seen the fear-mongering headlines that predicted or expected house prices to crash. Let's start by revisiting why so many experts believed a crash was imminent. Why did it seem inevitable the market would tumble? Section 1, the fear of a housing crash. The UK housing market has always been a focal point of intense speculation and concern. With soaring house prices, economic uncertainty, and rising interest rates, many experts and analysts have warned that a housing crash might be just around the corner. To understand why so many feared and fear a crash, we need to look at the underlying factors that fueled these predictions. First, the rapid increase in house prices outpaced wage growth. As house prices increased at faster and faster rates relative to wage inflation, it made it increasingly difficult for buyers to enter the market or work their way up the ladder. This naturally led to concerns that the market was overheating, similar to what we saw before the 2008 financial crisis. However, as is the case for most of these headlines, the moment you break the data down further, you start to realise the moment you separate the extreme numbers in London, where prices reached 11 times salary, you can see that the house prices in the north, Scotland and Northern Ireland, despite high relative to wage inflation, are still below the levels that led to the last financial crash. So all of a sudden, the picture doesn't really look so bad. Secondly, rising interest rates added fuel to the fire. As the Bank of England hiked interest rates to combat inflation, mortgage costs surged, creating financial strain for many homeowners. The concern is this would trigger homeowners into financial distress, potentially leading to a wave of forced sales, triggering a drop in house prices. And although mortgage arrears have been on the rise, it hasn't been anywhere near a big enough increase to trigger a crash. Bear in mind, mortgage arrears were over 10 times this volume in the 2008 financial crash. These factors, combined with the memories of the 2008 crash, where many lost their homes or found themselves trapped in negative equity, contributed to this widespread fear that the UK was on the brink of another housing crisis, another housing disaster. But despite these fears, the crash that many predicted never fully materialised, at least not in the form that we anticipated. So why didn't the housing crash happen? That's what we'll explore in the next sections. Reason 1, stronger lending practices. One of the main reasons the housing crash didn't happen is because of much stricter lending practices compared to the past. After the 2008 financial crash, the UK government introduced tougher rules to make sure that only people who could truly afford a mortgage were able to get one. So you can see from this graph that when you get a mortgage at a 3, 4, 5, even 6% interest rate, you're actually stress tested that you can afford that mortgage even if it got to 7, 8, 9%. This has made the mortgage market more stable, lowering the chances of too many people defaulting on their loans all at once. So that if interest rates did rise, which they did, people aren't being caught off guard. Another important factor is the increase in homeowners taking out fixed rate mortgages. This graph shows the proportion of new homeowner mortgages taken out on a fixed rate, and you can see over the decades the percentage of mortgages being taken out on fixed rate deals has pretty much become the norm, which is super important because most people being on fixed rates has created a protective barrier to households. If interest rates go up, that isn't going to affect your fixed rate mortgage until it comes time for a new renewal, which could be years away. Yes, you may be unlucky and find your mortgage is due for renewal in the short term, which that would of course create huge short-term pressure for that small percentage of households. But the key is that it's not going to hit every household at once, especially when you consider there has been a growing trend of people taking out 5-year fixed mortgages rather than 2-year fixed mortgages. All this helps to smooth out any pressure of unexpected sharp increases in interest rates like we've all seen. Reason 2, limited housing supply. Another key reason why the housing crash never happened is the limited supply of homes available on the market. Even as demand for housing remained high, the number of homes for sale simply wasn't enough to meet this demand, which helped keep prices from dropping too much. Also, the construction of new homes has been lagging behind what's been needed for years. This shortage of new homes has created a situation where even though there's so many people priced out of the market, there's still enough buyers looking to buy that keeps prices stable. And additional pressures add up, as despite the fact that there were only 400 more births than deaths in the UK last year, we've actually still experienced the biggest rise in population in England and Wales for 75 years. How? Because of the effects of net migration. You can see in the red line our natural pace of population growth has actually been dropping for over a decade. However, the effects of net migration is actually what has been keeping our population growing. So you add the limited supply of homes that has been a major factor in preventing a housing crash, with fewer homes available and steady demand because population's been increasing, prices have been supported, avoiding the steep drops that many people feared. I know immigration is a very divisive topic out there, but if we had no immigration, then we would likely see our population begin to collapse, and it is still debated if this is a positive or negative thing. But it's worth watching the short clip of Elon Musk to get his thoughts on this.
Assuming that AI is fine, assuming that there's a benevolent future with AI, I think that the biggest problem the world will face in 20 years is population collapse.
I agree.
I want to emphasize this. The biggest issue in 20 years will be population collapse. Not explosion, collapse.
So look, irrespective of this, I think most would agree we need a healthy balance on immigration. I'm interested in what you guys think though on this. Start a debate below on what you believe a healthy balance of net migration should be, because it is such a controversial topic at the moment. Reason 3, government intervention and stimulus. Another important reason the UK housing market avoided a crash is simply due to government intervention and stimulus measures. When the economy was hard hit by the COVID-19 pandemic, the UK government quickly stepped in with various programs to support homeowners and keep the market stable. One of the key measures was the introduction of the stamp duty holiday, which significantly reduced the tax on property purchases. This encouraged more people to buy homes during a time when the market might have otherwise completely slowed down to a halt. This policy played a major role in boosting the housing market over that time, leading to a surge in demand and helping to keep house prices from falling. That was the fear at the time. In addition to the stamp duty holiday, the government also introduced other stuff like the mortgage payments holiday, allowing homeowners who were struggling financially to pause their mortgage payments. This measure was crucial because it prevented a wave of what could have been forced sales that could have driven house prices down to the floor. Moreover, the Bank of England played its part by keeping interest rates at historic lows, which made borrowing money so cheap and more accessible. Low interest rates meant that even as the economy faced the challenges that we did, the cost of taking out a mortgage remained at record lows. These government interventions, along with the financial support provided during the pandemic, were essential to maintaining confidence in the housing market and, importantly, building resilience within it. Without these measures, we could have seen a very different outcome when interest rates started to increase again, with prices dropping significantly and a potential market crash. So look, in summary, what I'm getting at here is the government intervention through policies like the stamp duty holiday, the mortgage payments holiday, and the Bank of England's low interest rates played a critical role in stabilising the housing market ahead of interest rates beginning to rise, that in a way could have prevented a crash. Reason 4, they sort of have crashed. A big reason house prices haven't fallen is because of inflation being so high. So for example, if we look at house prices adjusted for inflation, the picture looks entirely different. You can see from this graph that when you adjust house prices for inflation, they actually have dropped 16%, because although house prices have stayed roughly the same over the last 2 years, we've at the same time seen record levels of inflation that has devalued the pounds in all our pockets. You can see in the last financial crash, house prices dropped about 20%, all adjusted for inflation. Back in the last crash, inflation wasn't the issue, so very little of that house price drop we saw was hidden by inflation. House prices dropped about 18 to 19% in the last crash. Adjusted for inflation, they dropped 20%, so pretty similar. That's not the situation we're in right now. Over the last 2 years, house prices have dropped at most 2-3%, which seems incredible, but adjusted for inflation, it's actually more like 16%. So in reality right now, in real terms, we have experienced a house price crash similar to that seen in 2008. It's just been hidden by the huge amount of inflation we've had. I think it also surprises people that, adjusted for inflation, we haven't actually seen house prices surpass the peak from just before the last crash in 07-08. In effect, average income has been growing faster than house prices. Yes, I fully appreciate that purple line shows how, despite a 7.3% increase in pay, it still equates to the average wage being 1.7% worse off, just because of how inflation has pushed up the prices of everything. However, when you relate wage growth specifically to that of house price growth, that 7.3% growth is far, far higher than the house price growth we've been seeing. All of that is helping to minimise the pressure on the likelihood of nominal house prices dropping or crashing. So what are the potential risks ahead? While the UK housing market has shown remarkable resilience, it's important to recognise that there are still potential risks on the horizon that could impact the market going forward. 1, rising interest rates. Yes, they've started to drop, but if inflation starts to rise again, then interest rates will too. And with so much global instability, something entirely unrelated to us, like China going to war with Taiwan or another pandemic, could massively disrupt supply chains and smash up inflation. Next is affordability issues. Despite some of the stabilising factors we've discussed, affordability still remains a concern for many potential buyers out there, particularly first-time buyers. If wages don't keep pace with the cost of living and house prices, the market could see a reduction in demand, especially among younger buyers who are already struggling to get onto the property ladder to begin with. This could eventually lead to a complete slowdown in the market. Well, next, government policy could change. Lastly, any significant changes in government policy, whether it's related to taxation, housing regulations, or immigration, could have a huge impact on the housing market. For example, if the government were to remove current incentives for home buyers or introduce new taxes on property investments, it could completely dampen demand and lead to a softening of prices. So anyway, thanks for watching, and if you found this video helpful, don't forget to like, subscribe and comment below, and I'll see you in the next video.